Laura Anthony, founding partner of Legal and Compliance, a full-service corporate securities and business transactions law firm. Today is the first in a LawCast series talking about direct public listings. On April 3rd, 2018, Spotify made a big board splash by debuting on the NYSE without an IPO. Instead, Spotify filed a resale registration statement registering the securities already held by its existing shareholders. The process is referred to as a direct listing. As most of those shareholders had invested in Spotify in private offerings, they were rewarded with a true exit strategy and liquidity by becoming the company's initial public float. In order to complete the direct listing process, the NYSE had to implement a rule change. NASDAQ already allows for direct listings, although it has historically been rarely used. To the contrary, a direct listing has often been used as a going public method on the OTC markets, and in the wake of Spotify, may gain in popularity on national exchanges as well. As I will discuss in this LawCast series, there are some fundamental differences between the process for OTC markets and foreign exchange. In particular, when completing a direct listing onto an exchange, the exchange issues a trading symbol up front, and the shares are available to be sold by the selling stockholders at prevailing market prices at any time after the registration statement is qualified and the listing has been achieved. In an OTC Markets direct listing, a company must work with a market maker to file a 15C211 application with FINRA to attain a trading symbol. Moreover, the registered securities may only be sold by the listed selling shareholders at the registered price, regardless of prevailing market prices. However, once a company is trading on the OTCQB or OTCQX tiers of OTC markets, and as long as the offering is not considered an indirect primary offering, the company could amend the registration statement to allow shares to be sold at market price. Generally, an offering will be considered indirect primary if more than 30% of the float is being registered for resale. In a direct listing process, a company completes one or more private offerings of its securities, thus raising money up front, and then files a registration statement with the SEC to register the shares purchased by the private investors. Although a company can use a placement agent broker-dealer to assist in the private offering, it is not necessary. A benefit to the company is that it has received funds much earlier in the process, rather than after a registration statement is cleared with the SEC. The cost of completing an audit and legal fees associated with the registration process is expensive and is usually borne upfront prior to receiving investor funds in a traditional IPO process, which is one of the reasons for the popularity of bridge loans. Where a broker-dealer assists in the private placement, the commission paid to the broker-dealer for the private offering may be slightly higher than the commissions in a public offering. One of the reasons is that FINRA regulates and must approve all public offering compensation and commissions, but does not limit or approve private offering placement agent fees. A second reason that a broker-dealer may charge a higher commission is that there is a higher risk to investors in a private offering, and that those investors do not have an immediately available public exit strategy. I'm securities attorney Laura Anthony, founding partner of Legal and Compliance and producer of LawCast. Should you have any questions about today's topic, please visit securitieslawblog.com and lawcast.com or contact me directly. Inquiries of a technical nature are always encouraged.